You invested $500,000 into a Delaware statutory trust thinking you'd defer taxes and simplify your real estate management. But when you go to exit in 10 years, you discover that after all the fees, your $500,000 has shrunk to around $350,000. That's $150,000 in hidden costs that nobody told you about upfront. And the worst part? The DST sponsor's prospectus buried the real exit math in footnotes and appendices that most investors never read. In the next 8 minutes, I'm breaking down the exact fee structure that's hiding in DST prospectuses, showing you the real net proceeds from a $500,000 investment over a 10-year hold period, and revealing why the tax deferral benefit can evaporate entirely if you don't model the numbers first. And by minute 6, I'll walk you through the break-even calculation that tells you whether a DST actually saves you money or costs you 6 figures compared to direct real estate ownership. If you're considering a 1031 exchange right now, this completely changes the math. Let's start with the fee structure that most investors don't understand. When you invest in a DST through a 1031 exchange, you're paying fees at multiple layers, and most of them aren't immediately obvious. First, there's the acquisition fee. This is typically 1% to 2% of your investment amount. On a $500,000 investment, that's $500 to $10,000 right off the bat. This fee goes to the DST sponsor for identifying, underwriting, and acquiring the property. It's taken directly from your capital before your money even goes into the deal. Second, there's the annual asset management fee. This typically ranges from 0.5% to 1.5% annually, though I've seen some sponsors charge up to 2%. Let's use 1% as our example. On a $500,000 investment, that's $500 per year. Over 10 years, if we assume your investment stays relatively stable, you're looking at $50,000 in asset management fees alone. But here's where it gets worse. Many sponsors apply this fee to the gross asset value of the property, not just your equity. So if your $500,000 is part of a $5 million building with debt, the sponsor might be calculating the fee on that larger number. Third, there's the disposition fee. This is the big one that most investors overlook. When it's time to exit the DST, the sponsor charges a fee for selling the property and unwinding the trust. This typically ranges from 1% to 2% of the gross sale price. Let's say your property has appreciated modestly and sells for $550,000. A 1.5% disposition fee would be $8,250. Fourth, there are ongoing operating expenses. The DST sponsor charges for property management, maintenance, insurance, and property taxes. While these are technically pass-through costs, they are typically charged at a premium compared to what you'd pay for direct ownership. For example, a direct property owner might pay 8% of rental income for property management, but a DST sponsor might charge 10% or 12% because they're managing multiple properties and investors. Let me walk you through a real example to show how these fees compound. Say you invest $500,000 in a DST in 2024. The sponsor charges a 1.5% acquisition fee, leaving you with $492,500 actually deployed into the property. That's $7,500 gone before you even start. Over the next 10 years, you pay 1% annually in asset management fees. But here's the critical detail. If the property appreciates at 3% per year, which is reasonable for commercial real estate, the asset management fee also applies to that appreciation. Year 1, you pay $5,000. Year 2, you pay $5,150. Year 3, you pay $5,305, and so on. By year 10, your annual fee has grown to $5,735. Over the full 10 years, your total asset management fees amount to approximately $56,500. Now let's add the operating expenses. The sponsor charges 10% of net rental income for property management. On a $500,000 property, assuming 5% annual gross rental yield, that's $25,000 in gross rental income. The sponsor takes $2,500 for property management. Over 10 years, assuming consistent rents, that's another $25,000 to $35,000 in fees depending on rent growth. When you exit in year 10, the property has appreciated to approximately $670,000 at 3% annual appreciation. The sponsor charges a 1.5% disposition fee on this sale price, $10,050. But wait, there's more. The sponsor also charges escrow fees, accounting fees for unwinding the trust structure, and various other costs. These can total another $3,000 to $5,000. So let's do the math. Your original $500,000 investment is now worth $670,000 before fees. Deduct $7,500 in acquisition fees, $56,500 in asset management fees, $30,000 in property management fees, $10,050 in disposition fees, and $4,000 in miscellaneous unwinding costs. You're left with $562,000. But you still owe capital gains taxes on the appreciation of $170,000 unless you execute another 1031 exchange. If you're not doing another 1031 exchange and you're in the 20% capital gains tax bracket federal, you owe $34,000 in taxes. Your net proceeds drop to $528,000. You've made $28,000 on a $500,000 investment over 10 years. That's just 6% total return, or 55% annually. That's less than inflation. But here's the counter-argument that DST sponsors will make. You deferred taxes on your original $500,000 sale, which means you didn't have to pay capital gains taxes on that transaction. If you had sold a property for $500,000 and paid 20% in capital gains taxes, you would have only had $400,000 to reinvest. By using a 1031 exchange into a DST, you kept all $500,000 working for you. That's a valid point. The tax deferral does have value, but the question is how much value? If you invested $400,000 in direct real estate ownership without DST fees, would you come out ahead compared to investing $500,000 in a DST with all its hidden fees? Let's model this scenario. You sell a property for $500,000, pay $100,000 in capital gains taxes, and invest $400,000 directly into a property. You pay no acquisition fee, no asset management fee, and minimal property management fees, maybe $2,500 per year. Over 10 years, with 3% appreciation, your $400,000 grows to $537,000. You've paid approximately $25,000 in property management fees. Your net value is $512,000. You sell, and on the $137,000 appreciation, you owe $27,400 in capital gains taxes. Your final proceeds, $484,600. Compare that to the DST scenario where you ended up with $528,000. The DST actually comes out $43,400 ahead in this case, even with all the hidden fees. But that's only because you started with more capital. The real question isn't whether the DST strategy is better than direct ownership. It's whether the DST is the right vehicle for you specifically. Here's the break-even calculation you need to do before investing in any DST. Take your initial capital amount and calculate 3 scenarios. 1. Invest in direct real estate with no DST fees. 2. Invest in a DST with the fees I outlined. 3. Invest in a REIT or other liquid real estate vehicle. Run these scenarios over 10, 15, and 20 years and see which one nets the most money. The variables that matter most are your current tax bracket, whether you plan to do another 1031 exchange, the appreciation rate of the specific property, and the fee structure of the specific DST sponsor. For example, if you're in a high tax bracket, 35% plus, the tax deferral benefit of a DST is worth more to you. If you plan to do another 1031 exchange upon exit, the capital gains taxes disappear entirely, which makes the DST fees a much smaller drag on returns. If the property has strong appreciation potential, the fee structure matters less because the gains can overcome the costs. And if you find a DST sponsor with lower fees than the 3-4% I've outlined, the math changes significantly. But if you're in a moderate tax bracket, don't plan to do another 1031 exchange, are invested in a slow appreciation property, and choose a sponsor with higher fees, you could lose significant wealth compared to direct ownership. Critical action item is this: before you invest a single dollar in a DST, ask the sponsor for 10-year projection showing 1. Your initial capital, 2. Annual fees broken down by type, 3. The projected sale price and remaining equity, 4. The projected capital gains taxes due, 5. Your final net proceeds. If they won't give you this in writing, walk away. Reputable sponsors will provide